Hi there folks, hope you all had a wonderful summer with your family, nice relaxing break, ready to hit the ground running. I know I certainly did. I was away in the Philippine Islands with my family. We did lots of island hopping and scuba diving, lots of activities and so forth. Now back to the screens, back to work, got to pay for all this fun somehow. Now you know, one of the biggest, most commonly asked questions I get from the rookie and the novice trader is this. What is the best Forex strategy to use? What's the best time frame to use? What strategy will basically allow them to give up their day job and just use the Forex market as a free ATM? Now, quite frankly, it's a nigh on impossible question for me to answer without knowing more about the personality, the objectives, and so forth. But what I want to address today is not what the best strategy is, but the worst Forex strategies out there. The strategies that I think you should be avoiding at all costs. Today's video could save you a lot of time, energy, and certainly money. I hope you enjoy it. Okay, so before we get into the nitty-gritty about the worst Forex strategies out there, I want to remind you to subscribe to the channel if you don't already do so. That way you can watch all my past videos in one place. Now up to over 100,000 followers, subscribers, in fact up to about 147 now last time I looked, got my YouTube plaque to prove it. Don't forget now to hit that little bell notification, that way you'll be notified the next video the moment it's been released, and also don't forget to follow us on Twitter and of course Instagram. Now if you follow us on Facebook, you can tune in live every Monday afternoon 2 p.m. London time for a live event where myself and my colleagues discuss trading opportunities for the week ahead. Absolutely free to attend, so I look forward to seeing you in there. So since we opened our doors here at Forex Signals all those years ago, back in 2012, we've watched and analysed hundreds of different strategies in an attempt to conquer the markets. We spent literally thousands of hours looking for those top traders with some magic holy grail strategy that would enable us to print money all year round for ourselves and indeed our customers. Of course, we all know that the Holy Grail strategy, that doesn't exist, although we have found some hidden gems along the way. But this process has been invaluable because we've got to see firsthand what not to do, better than anyone else out there, I would imagine. Now, as you know, I've been in the markets for over 30 years, started my trading career in the trading pits all those years ago. I have seen it all. I know what to avoid. Now, anyone that's been around the Forex market for more than 5 minutes, chances are you've heard of the martingale strategy. Second thing you're likely to know about this strategy is that it is bad. It's only the losers, the gamblers and the charlatans that trade this strategy. Why the charlatan? Well, because they can tell you they have a fantastic win-loss ratio, maybe 90 or 95%. The last 50 trades have all been profitable. But what they don't tell you is that the take profit ratio and the profit factor is likely to be disastrous. Now, I don't want to bore you too much with the specific mechanics of the martingale strategy. You can research that yourself in your own time. There's plenty of information out there, Wikipedia for one. But the essence of the martingale is that it involves chasing your losses by adding subsequent larger trades to your losing position. So, for example, here you've got a downtrending market, finds a bit of support, comes back up, we now hit resistance. Your strategy might tell you this trend is going to continue, so you will want to be selling into this minor pullback. So you sell one lot. But on this occasion, for example, the market continues on its retracement, pulls back another 10 pips. You're now 10 pips offside. Some strategies will say you should use a stop loss, in which case you cut out of the position, you move on to the next one. Not martingale. Martingale will say, no, you don't take the loss here, we'll sell some more. So with 10 pips offside, we'll now sell another 2 lots. So we're now 3 lots short. The market only has to retrace 5 pips and you get out for a small profit. But again, on this occasion, the market doesn't retrace 5 pips, it continues up. Continues up another 10 pips. Okay, again, you could employ the stop loss, not martingale. Martingale will say, sell another 4 lots. Okay, so the market again only has to retrace 5 pips and you get out for a small winning trade or possibly a scratch, depending on the spread, of course. But now you've got a 7 lot short position the market's now 20 pips offside, and you're chasing this just to get back the initial money you lost on the first trade. And indeed, on this occasion, it goes up. Now, martingale, basically using this strategy, you'll win most of the time. But the times when the market doesn't retrace, that's when it will cost you, and that's when chances are it will blow up your trading account. This is a typical equity curve of the martingale strategy. Small profits, minor pullback, minor pullback, minor pullback, but then this happens and you go bust. So be very careful of martingale strategies and be very careful of the snake oil charlatans that are promoting this style of trading. Scalping strategies that are targeting less than 5 pips profit. I mean, how good is scalping? It's like sitting in front of an ATM gaming machine where you can generate pips after pips of profit, with the adrenaline and the serotonin flowing through your veins as you hit the winners after winners. It certainly beats sitting in front of a screen in an open plan office doing the accounts on some boring old spreadsheet or driving a forklift truck in the warehouse. You are your own boss and the money has never been so easy. But you're kidding yourself. You are at a huge disadvantage. Why is that? Well, because you've got to pay the spread and you've got to pay the broker's commission. Each time you hit a 4-pip winner, the market needs to move at 5 pips to cover the cost of trading, the spread and the commission. In this case, it's about 20% of your gain. You need to beat the markets really consistently well in order to counteract the cost of trading. It's all about the spread and the commission. Think of the spread or commission like the house advantage on a roulette wheel, for example. So you know if you play roulette, you've got that green zero. We know that the house always wins in the long run in roulette. Why? Because that's his edge, and that's exactly why the brokers will always win if you're trading for a 5-pip gain. It will erode away all your profits and eventually put your account into oblivion. And I haven't even mentioned the emotional side of it. We all know that psychology is the biggest killer of traders, and it's way more intense down there on the lower time frame charts when you're trying to scalp out those 5 pips. So I would say if you're looking to scalp the markets, you don't want to be targeting just 5 pips. The commission, the spread and the emotions could be the killer. And another strategy that I think you should be avoiding are those strategies that trade too many different pairs. Does a Frenchman behave the same way as an Englishman? Hell no, of course they don't. So why do you think that their currencies should behave in the same way as well? Every country is unique. They all have their own quirks, their own different way of doing things. You know, I've seen a lot of traders over the years applying the same technical analysis strategy across multiple different currency pairs. Why do you think they do this? Well, more often than not, it's because they're bored and they have this compulsion to always be in a trade. Very dangerous. They may have a very high probability breakout or trend following strategy that works great in the euro against the US dollar. But does that mean it should work well against the Swiss and the yen, which, as you know, are heavily correlated currency pairs, both being the safe haven currencies, as you well know? The Aussie and the New Zealand, for example, another heavily correlated currency pair. Not the best, I would say, for breakout strategies. And think about it for a minute. Think about the Asian session, often the quieter part of the trading day. Certainly quieter than the Euro and the US session. So why should you be trading the CAD and the Swiss, do you think, during the Asian session? It won't be as active, and it won't be as active, of course, because it's not in the same time zone as those currency traders that are working in those countries. Don't be juggling too many different currency pairs when you're starting off. Focus just on a handful. I would say 1, possibly 2 as well. Paying close attention to how that currency works and the correlations between the other currencies as well. And lastly, but by no means least, it's the strategies that have so many different working parts you don't know what's working and what is not. Believe me, I have seen it all over the years. Some traders' charts where you can literally not see where the price is. Think of a Formula 1 racing car, thousands and thousands of different working parts. When one of those working parts goes wrong, the race is lost. Don't make your strategy the same way as that. Putting in an extra filter to your strategy to prevent that losing trade will result in failure. You remember that video I put out when we got going all those years ago, the cycle of doom, why you'll never make money in the forex market? Got over 1 million views now. Check it out when you can. You've got to accept that all strategies will have losing trades. So they'll have losing runs as well. Don't be making your strategy so complicated it loses its focus. You know, the best strategies out there are the simple ones. A trader should expect to have losses. They expect to have gains, but of course they expect the latter to far outweigh the former over a large sample of trades, of course. Now, if you haven't seen the video I released last month, it was a simple to follow trend following strategy. I've got absolutely loads of really positive feedback on that. So if you haven't watched it already, I encourage you to do so now. It looks basically on pure price action, strips out all that noise. Also, it keeps you in the trend for as long as the trend wants to continue. So as I say, watch it straight after this video. Please, of course, let me know what you think about it as well once you've had a chance to review it. And of course, this video as well, leave a comment. As always, I get back to each and every one of them. So please be careful out there of the strategies that appear too good to be true, offered quite often by those snake oil charlatans for 99 bucks. Those that tell you they have a 95% win to loss ratio. Chances are they're taking 10 pips profit, but when it loses, they could be into the hundreds. The win loss ratio is great, but it'll only turbo your account into oblivion when the inevitable drawdown happens. As always, I hope you liked the video. As I say, leave a comment. I'll get back to each and every one of them. Don't forget to follow us on Facebook. If you follow us on Facebook, you can tune in live every Monday afternoon, 2 p.m. London time, for a live event where we discuss market opportunities for the week ahead. Follow us on Instagram and, of course, on the Twitter. Until the next video, happy trading and good luck.